It's Brian Preston, the money guy.
If we just go look at the Investopedia definition of inflation, it is the decline of purchasing power of a currency over time, often reflected by a general rise in prices. Basically, it means the cost of the things that we use on a day-to-day basis becomes more and more expensive, and the value of each one of our dollars becomes less and less valuable. And it certainly seems like right now, we're having that take place at our present state.
So if I'm hearing you, things are going up, costing more to buy. I know we're having supply chain issues and other things, but I don't know if that would be such a problem as long as wages and other things are keeping pace, right?
Sure, yeah, that's the general idea, that so long as the compensation we receive for the jobs that we do increase at a commensurate rate with inflation, then it's okay. You can still buy the same amount of things, but it doesn't sound like that has actually been what's been going on.
So if you look at the graph of what's actually been going on with wage growth, wait a minute. But I think I see a problem here. That's negative. That says a loss of 6.1%.
Yeah, so for those of you that are out in podcast land not looking at the visual, we're showing year over year quarterly wage growth. And all through 2020, year-over-year wage growth had increased, albeit at a decreasing rate. But now when we look at Q2 of 2021 relative to Q1 of 2020, wages are down about 6.1% over that time period.
Okay, so this is, you can probably see all the negativity.
Mm-hmm.
People are nervous. Let's tackle each one of these. The first thing that I hear people talking about, and we've kind of given it up already, purchasing power, which is another way to talk about the general impact of inflation.
And so obviously the best way for us to measure that is determine, okay, well, are things actually becoming more expensive? And if they are, what things are becoming more expensive? So we had Daniel go do a little research, and this is from the Bureau of Labor Statistics. You can see that like right now, presently, rental cars are up about 43%. Gas is up about 42%. Used cars are up 24%. Hotels are up 18%. Televisions 13%. Furniture 11%. And then household food items, so meat, poultry, fish, eggs, up about 11%.
So we were talking just the last few days. You were talking about taking the family back down to Georgia and to visit family. You're like, I think I'm going to rent a car because I don't want to put the miles on my actual car. And I was like, yeah, you might want to go see what's going on with rental cars before you book that. So, and by the way, what makes this not feel completely normal is that there is this disconnect between inflation and what's going on with interest rates. If you think about this, if you compare inflation versus the 10-year Treasury rate, you can see historically there has been some type of correlation where they're running together. But right now, you can see inflation is through the roof, and 10-year Treasury is being kept artificially low. This creates a very unique situation.
So then the question becomes, okay, if our purchasing power is decreasing, right? If wage growth is not growing, inflation is increasing, there's this spread between the Treasury rate and the inflation rate. What is a financial mutant to do? What are some things we can think about of ways to offset this or ways to combat against this if this is what we're going to experience into the future moving forward?
Well, if you know our interest rates are artificially low, it's going to make sense that you need to own stuff. Because we have inflation. We have both two things going on. We have inflation plus artificially low interest rates. That is concerning. So I would encourage you, look, historical hedges to inflation, real estate.
Yep.
And by the way, you don't have to go load up on 20 rental houses in your community if you don't want to deal with the headache. You can do REITs. There's much easier ways to just go ahead and get access. You can even do, real estate mutual funds through Vanguard, Fidelity, Charles Schwab. They all have their versions.
And I think a lot of people are surprised that actually is a great way to get real estate exposure, even though you're not buying the tactile land. Because what those funds or what those ETFs are doing are in fact participating in the real estate market. So it's a very low barrier to entry, cost-effective way to get real estate into your overall investment portfolio.
Now, I like, because most of you out there watching this, you're going to have your retirement accounts, you're going to have your savings and investment accounts. There is nothing wrong with traditional like S&P 500 index funds that are probably a large part of your index target retirement funds if that's the way you're investing. And here's why this is a great inflation hedge. realize when inflation shows up on the scene, the companies that make up these indexes have the ability to raise their prices. We have shown on quite a few shows that late 70s to early 80s period where we had another period of runaway hyperinflation.
Double-digit inflation
and
rates.
guess what? A lot of people always remember that, yes, CDs were paying double digits back then. They fail to remember when the S&P 500 was making 15, 20, 30% per year, keeping pace and even exceeding where inflation was during that same period of time.
Now, there's a trade-off because oftentimes when we talk about inflation happening, people get really nervous about what's going on economically and how strong the economy is. You have to understand that when you are using equities, when you are on the risk-on side of your portfolio, there's likely going to be short-term volatility, but it's that volatility that presents the opportunity for you to be rewarded over the long term. So don't allow your fear to force you to run away from an asset class that you probably need in your corner if you're going to try to hedge against rising prices over the long term.
I put this last one in here just because we do want to nudge and pay respect to something that I hear top of mind. Everybody's putting on their forum posts, and we see it in our comments section, Bitcoin and cryptocurrencies. And here's the thing. I understand why these are inflation hedges because they are limited quantity, meaning that they have announced how many Bitcoin are going to be allowed to be mined. That allows you, just the fact that there is scarcity does protect you from inflation. No different than gold historically.
Sure.
This is kind of like the modern 21st century version of gold. The problem I have with it is that, man, oh man, is this very speculative and volatile. And we put up on the if you're watching this on YouTube, you can see the actual graph of what the price of Bitcoin has looked like. It is not for the faint of heart. So that's just something to be mindful of if you're going to wade into this area. Be careful because right now it more resembles a speculative holding versus a long-term investment. Now, look, a lot of people, because I hear people constantly posting, this thing's going to 100,000 by year end.
Sure.
Who knows? But I just understand your why and also make sure that you're not getting caught up in the momentum trading that a lot of people are really getting excited about.
So inflation and decrease in purchasing power and the rising cost of goods might be one reason why Americans may be feeling or maybe becoming poor.